Yeah, in the previous session, we have seen what are the different sample selection techniques and also the different approaches to sampling. So we have seen what are the different ways in which the auditor can select the sample. Now coming to the next topic, what is called as sampling risk. What is sampling risk? What are the different types of risk? Sampling and non-sampling risk. What are the factors on which the sampling risk is based and what are the factors that should be taken into consideration for deciding the sample size? What is sample size? What are the different types of errors associated with sampling? All these concepts we'll be seeing in this session. Now, first coming to the topic, what is sampling risk? So, as we already saw, what is audit risk? The risk of giving an inappropriate opinion by the auditor. Here also there is a risk involved. This risk is mostly associated with the sample selection. Say for example, the auditor is selecting a sample based on his knowledge, prior experience and also based on his judgment. It could be subjective or there could be some kind of bias or maybe sometimes even without any bias also he is selecting a sample. Sometimes whichever sample he selects from the population, it might not represent the population. It might go wrong. So there is some kind of a risk associated with selecting the wrong sample. This kind of risk associated with selection of wrong sample is called as a sampling risk. Say for example, I am applying the audit procedure. There are 1000 transactions. 100 transactions I am selecting as a sample. From this 100 transactions, in the 100 transactions I apply the audit procedures and I get a result. Now, the same audit procedure, say for example, I am vouching each and every transaction, hundreds of transactions I am vouching. The same audit procedure I am applying to the next 1000 transactions. The entire population, that is the entire set of transactions. Same audit procedure if I apply. In an ideal scenario, the result obtained from the small audit sample and the audit population should be identical, should be one and the same. It's because the sample is representative of the population. Now, certain scenarios or certain circumstances, the result of this particular audit sample and the audit population might not be one and the same. And even though they are subjected to the same audit procedure. Now what happens? Such scenarios gives rise to the concept of sampling risk. Now I can say there is a sampling risk because I have selected the wrong sample and I have applied the audit procedures, because of which the result of the audit procedures in the sample and the result of audit procedures in the entire population are different. So same audit procedures I apply by verification or apply vouching, or I even do a calculation. Both I do, sample and the population, but the result I obtain is different. Such scenario I can say there is a sampling risk. Now, how can I reduce the sampling risk, or to what extent the sampling risk should be reduced? Now, sampling size or the sample size I should select the sample size. The auditor should select the sample size in such a way that the sampling risk is reduced to an acceptably low level. So he has to make sure the sampling risk is negligible or it is at a very, very low level. So in such a way I have to select the sample size. So anyway, I cannot completely nullify the risk because there is some kind of an inherent risk, but still the auditor should be very careful in selecting a sample size such that the sampling risk is reduced to an acceptably low level. Now for this, how should the sample size be? Normally, higher the sample size, lower will be the sampling risk, because I'm doing an extensive checking or vast checking. Okay, so in such cases, when the higher is the sample size, your sampling risk will be comparatively less. That's one scenario. Say for example, I'm selecting 20 transactions. Out of these 20 transactions, I apply some kind of an audit procedure and I find out that 5 transactions are wrong. Or there are 5 transactions which are materially misstated. Now, this 5 out of 20, that is a 25% of the transactions is actually materially misstated or it is wrong. Now, the auditor comes to a conclusion that the internal control is ineffective because more or 25 or more than the transactions are wrong. So in such cases, the auditor is coming to a conclusion about the ineffectiveness of control. Now the same example, instead of taking 20 transactions, I take a bigger sample size. Say 1000 transactions I take. There are a number of transactions, but I take 1000 transactions. Now, when I apply the audit procedures on this 1000 transactions, still I am getting only 5 transactions which are wrong or materially misstated. For example, 5 transactions which are materially misstated. So what does it show? Even when I selected 20 transactions, the same happened. And when I selected 1000 transactions also, the same 5 transactions were materially misstated. Now, percentage wise, if you see 5 out of 20, it is a 25% of transactions are wrong. Here, 5 out of 1000 is still a 0.5 of the 0.5% of the transactions are only materially misstated. Now, the auditor, what conclusion does the auditor come when he does a checking of 1000 transactions? Only 0.5 is materially misstated, which comes under the tolerable range of deviation. So, it is fine or it may be acceptable. Now, the internal control or the effectiveness of internal control perspective of the auditor has changed. Now, it has become effective. Now, what has changed is, it is not the internal control that has become effective or not. It is because the sample size for which I use for checking has increased. 5 transactions out of 20 give me a huge percentage of material misstatement. Now 5 out of 1000, the same number of transactions are materially misstated. But what happened means my scope of checking has increased. Instead of checking 20, I have checked 1000. So higher the sample size, lesser will be your sampling risk. Now, this sampling risk can give rise to 2 situations. One is with respect to controls, testing the controls, and one is with respect to material misstatements. So we will see what are the different possibilities or what are the different erroneous conclusions that the auditor can reach. One is with respect to test of controls. Now, with respect to test of controls, what are the 2 kinds of risk that the auditor can come across? One is sometimes the controls might be more effective, appear more effective than they actually are. Say for example, here I'll tell about a small product, like say for example saffron. So everyone knows saffron is one of the very costliest spices, one of the costliest things here. So it is almost per gram itself, it costs around 300 rupees. So imagine how much 1 kilo costs. It is around 2 lakh something. It costs 2 lakh 50, 3 lakh it costs. Now, there is a company which is manufacturing a particular product using this particular saffron. So using this saffron, it is manufacturing a particular product, and say for example, it is using 30 grams of saffron in a particular product, and this particular 25 to 30 grams of saffron in a particular product, and this product is manufactured. Each unit of this manufactured product is sold for say 10,000 rupees. 10,000 rupees it is being sold for. Now, the auditor has gone for a verification of the particular manufacturing unit, and he finds there is each and every section of the manufacturing unit is being verified by the auditor, and he finds that there is a proper surveillance system, there is proper monitoring of what happens within the particular manufacturing unit. So what happened was, in the, say for example, in the particular quarter, every month they are producing 1000 units. Every month they are producing 1000 units, but in that only 920 units were sold. Only 920 were sold, and the remaining 80 units were told as if it was a normal loss. It was lost, or it was destroyed in the course of manufacture. So 80 of the units were lost. It was a normal loss, and only 920 units were sold. Now, when the auditor actually inspects the facility, he finds there is a proper surveillance system, there is a proper monitoring of what is happening here, and he finds that controls are very effective, designed. It is kept at the vital points. It is capturing everything that is happening within the particular in manufacturing sector, and he is satisfied with the effectiveness of control. But though there are controls there, say for example surveillance system, there is a huge circumvention of controls happening. Say there is a supervisor who is checking how the people are working. So here the supervisor is abusing his responsibility is such that even though there are 1,000 units produced and only 920 is given for sales, 80 units is actually, it's a theft happening. There is some kind of a theft happening there. But this 80 units, it is being shown as it is being lost or it is being damaged. Now, the supervisor is well aware of that fact. He is abusing his responsibility or his power, circumventing the controls, and he is also getting associated with the staff or the manufacturing team, and that 80 units, whichever is being actually it is a theft, whichever is being not sold, they are selling it to a, they are selling and they are getting the profit or they are getting the amount for that. Now, the auditor believes that the surveillance system is working fine, proper monitoring happens, but in actually, even though there is a control present, effectively implemented, effectively designed, a control is there, but what happens is this control is not being monitored properly or it is not doing the function what it is supposed to do. Say for example, it is being monitored by the supervisor. Supervisor himself is abusing his power, circumventing the controls, and finally there is a collision among employees and they are doing some kind of fraud so that the 80 units is not sold by the company but they are selling it privately and getting the profits. Clear? So in this case, the controls are appearing more effective and than they actually are. So what happens is the auditor saying there is a surveillance system, he just asks the supervisor where all the visuals for the particular manufacturing is there, and he says, and he sees one or two visuals and then he finds he's satisfied with that and he leaves. And what happens? Auditor feels that the controls are effective. In such a case, controls are ineffective. What happens? The audit effectiveness is lost. The auditor feels it is effective, and because of that he gives a report which is a clean report or a unmodified report because he feels there is no kind of theft or defalcation happening there. Finally everything is there, there is no kind of fraud, there is no misstatements, and finally he gives a clean report. But actually what has happened? The audit effectiveness has been affected, and because of that the auditor is giving an inappropriate opinion. So when the controls are appearing more effective than they actually are, it affects the audit effectiveness and gives or leads the auditor to give an inappropriate opinion. This particular scenario, I can call it as risk of inappropriate acceptance. I am accepting something which is inappropriate. The controls are not effective, but I accept it as being effective. So risk of inappropriate acceptance. Now the second, I can also have another side to it, another side of the story. Controls are actually very effective, but they appear less effective to the auditor. Same scenario I can take. There is a surveillance system. Auditor sees a surveillance system. Auditor, say for example, there is no surveillance system. In the same case, there is no surveillance system. Auditor checks each and every section of the particular manufacturing facility, and if he finds that there is no kind of a monitoring system or surveillance system, he feels the internal controls are ineffective. But actually what is happening is here there is a supervisor who checks each and everything that is happening within the manufacturing facility, and there is also one among the employees who are a person who is alibi or something. He is one among the employee. He is also responsible to check what is happening during the manufacturing of that product. So but nobody knows that. So here there is a double layer mechanism or double layer checking happening of how the products are manufactured, and any kind of deviation or any kind of loss or theft, it will be immediately reported by them. So even though there was a surveillance system or a surveillance CCTV camera in the previous example, this control is more effective than the controls which were there and circumvented. But in the eyes of the auditor, when he sees around, looks around, there is no kind of a surveillance system, there is no kind of monitoring happening. What he feels, the internal control system is very ineffective, or it appears less to the auditor. But it actually is not that less. It is more effective as compared to the first case. In such cases, when the control appears less effective than that it is actually is, In such cases, it affects the audit efficiency. Why it affects the audit efficiency is auditor feels it is less. So what happens? In order to make sure what other controls are implemented so that there is no kind of fraud or misstatement happening, he will actually do additional audit procedures, which leads to additional effort. So it not only affects the audit efficiency, it also leads to additional efforts. This kind of risk which leads to additional effort affects the audit efficiency is called as risk of incorrect rejection. Something is correct but I'm incorrectly rejecting it. Controls are effective but the auditor feels that the controls are ineffective and rejecting that and seeking new audit procedures or applying new audit procedures to verify the same. So additional effort also involved. So basically there are two risks, risk of incorrect acceptance and incorrect rejection. Controls are appearing more effective than they actually are. Controls are appearing less effective than they actually are. One affects the audit effectiveness and gives an inappropriate opinion. One is the audit efficiency leading to additional effort. Now, sampling risk is in the case of test of controls. We already saw two erroneous situations. One is with respect to test of controls. The other is with respect to material misstatements. Material misstatements, same case I can take and I'll tell the same case. In the first case, when the CCTV or surveillance system was present, auditor feels the controls are very effective, but in the actual scenario, controls are not effective. In that case, actually the controls are not effective, because of which what happens, 80 units are being, there is a theft of 80 units from that particular production or manufacturing facility. 80 units, and this 80 units are being sold for 80,000 rupees. Say for example, it is being sold for 80,000 rupees. Now each unit 10,000 and it is sold for 80,000 rupees. Now this 80,000 profit, whichever they obtain, is shared among the employees or the workers there. It is not going to the company. What happens? The total sales is reduced by 80,000. The total profit associated with it is also reduced. What happens? There is a kind of a misstatement. This material, this 80,000 amount is material to the company. Say for example, it is material. In that case, there is a material misstatement happening, but it appears not to exist where it actually does. So in the eyes of the auditor, controls are effective. As a result of which, this is not a material misstatement. This is a normal loss. But in actual scenario, this is a case of fraud. This is a case of theft, as a result of which there is an 80,000 or turnover loss to the particular company. So as a result of which there is a material misstatement happening, but it appears not to exist where it actually does. Similar to the case of controls appear effective than they actually are. What happens? Your audit effectiveness is affected and also leads to an inappropriate opinion. Now see the other case. What is the other case? Material misstatement appears to exist where it actually does. So material misstatement appears to exist where it actually does not exist. So sometimes material misstatement is not there, but the auditor feels there is some kind of a material misstatement. The second scenario, no surveillance system present. He feels that the controls are ineffective. He does additional audit procedures to confirm the same. He feels there could be material misstatement because of ineffective control. But in actual case, the controls are effective and there is no material misstatement, as there is no fraud or theft happening. In such cases, what happens? Because of this auditor's wrong judgment with respect to the existence of material misstatement, it has increased his effort. He is performing more audit procedures, affecting the audit efficiency, and additional audit effort is required. So this particular case is again a case of risk of incorrect rejection. Incorrect rejection, and the other one is risk of incorrect acceptance. So these two are the sampling risk associated in case of test of controls and also associated with risk of material mistake. Now, since we already discussed what is sampling risk, what are the different types of risk, what are the different types of sampling risk in case of controls and with respect to material misstatement, we'll see what is sampling risk, sample size. So as I told you, what is a sampling risk. So see, already we discussed what is the sampling risk. So what sampling risk that the particular auditor is willing to accept, similar to the risk appetite the company is willing to take. Say what is the level of sampling risk the auditor is willing to accept. This factor decides or it affects the sample size required. Say the auditor is willing to accept a huge sampling risk, then the sample size can be even very small. Depends on the level of sampling risk the auditor is willing to accept. Now, it is this particular sample size I can determine either by a statistical method, scientific approach, probability theory, or I can do it by professional judgment with my experience and knowledge, with the auditor's prior experience and knowledge. So, but whichever method you choose, either by a scientific method or by the prior experience, when the circumstances remain the same, say for example, there is some kind of a fraud happening under the company, circumstances are remaining the same irrespective of whatever method is applied, is used for sample selection, whichever approach is taken, the sample size will be the same. So, sample size depends upon the level of sampling risk the auditor is willing to accept. Now, what are the factors that affects the sample size? We'll see the factors. Now, telling about the factors that affect the sample size, first is higher the auditor's assessment of risk of material misstatement, higher is the sample size. That means what? Higher the risk of assessment of risk of material misstatement. So, what is risk of material misstatement actually? Risk of material misstatement or audit risk? Audit risk is basically a product of your control risk, detection risk, and inherent risk. Inherent risk, risk which cannot be reduced, which cannot be eliminated, can only be reduced because there is some kind of risk that always exists. Detection risk is what? Detection risk is the risk of giving or not able to detect the misstatement, not able to detect a misstatement, auditors associated with the auditor. Control means where the controls are not effective or not implemented or not functioning properly, risk associated with that. Now, the total audit risk will be a product of all the three: detection, control, and the inherent risk. Now, if you see, the risk of material misstatement alone is a product of your control and detection risk. So, if you want to summarize, audit risk is nothing but the risk of material misstatement and the detection risk, how the auditor is detecting that. Now, say for example, the sample sizes are, say for example, the control test of controls is not being performed by the auditor. Auditor is not performing the test of controls. In such a case, if the auditor wants to make sure that the detection risk is low, or if he wants to maintain the detection risk low, if he is making sure that he want to detect any kind of errors or misstatement that arises, in such case, what the auditor should do is not performing the test of controls, but he wants to make sure that the detection risk is low. So in such a case, he will go for test of details. There is no test of controls. Now the next only way is what? Test of details. I'll go do a detailed testing. I'll do a substantive testing. So that means what? When I do a detailed testing, the sample size will be more. So higher the sample size when higher is a risk of material misstatement. So in higher the risk of material misstatement, higher will be the sample size. Say for example, in this particular example itself, when I'm doing some kind of a substantive procedure, say sales, I'm comparing current quarter sales and previous quarter sales. Say for a particular assertion, cutoff procedure, completeness of the transactions I'm checking. I find that using an analytical procedure, some kind of a trend analysis or some kind of total turnover analysis, I find that the total turnover with respect to the previous quarter is much different, significantly different than the current quarter sales or turnover. Then I find that it is because few entries were not recorded or certain other reasons. Now, already I have applied few other substantive procedures, like I'm testing in detail that particular period transactions. I am applying analytical procedures in cases wherever the auditor is applying other procedures, other substantive procedures for the same assertion. So here the assertion is completeness. I am applying more than one substantive procedure for the same assertion for obtaining some kind of evidence with respect to same. In that case, since I'm applying many procedures on the same assertions, my sample size will reduce. I need not go through entire transactions. I can take 5 transactions. I am also using analytical procedure to analyze a different quarter um, differences. Say for example, I'm using a trend analysis. I'm also seeing the gross profit ratio. I'm checking various other factors. So in such cases, I need not go through all the transactions. My sample size will obviously reduce. Then, higher the tolerable level of misstatement, tolerable misstatement level, lower is the sampling risk. That means what? Higher the tolerable mistake means the acceptable level of error is more. Say for example, totally there are transactions worth rupees 10 lakhs. My tolerable misstatement level is up to 2 lakhs. Any kind of misstatement that is tolerable, very higher level of tolerable misstatement or acceptable error. In such case, I can reduce the sample size. I need not go through all the transactions. Even though the transactions, if only the sample size, whichever I have selected, shows a tolerable misstatement level of more than 2, then I need to worry. But when the level of tolerable misstatement is high, I can reduce the sample size. Similar with level of assurance. When the level of assurance required is more, that means what? I need to make sure that the transactions are complete and accurate and reliable in all aspects. Higher the level of assurance, I have to check. I have to do an in-depth checking or my sample size will increase. So that is a factor influencing the sample size. Next is better stratification, lower the sample size. That means what? Better stratification, say I have a population of 1000 transactions. It is ideally stratified or divided into 5 groups, 200, 200, 200 transactions each. In that 5 groups of transactions consisting of 200 transactions, these 200 transactions cover different monetary values of transactions. Say for example, some transactions are as low as 100 and some transactions are as high as 1 crore. So it's a mix of all the different amounts of transaction or different monetary values of transactions are covered in one particular group. If such kind of divisions or if such kind of divisions are possible where it consists of a mix of transactions which will be equivalent to checking all the transactions at one go, in such a case better the stratification, I can lower the sample size because it has a mix of all the transactions. It is representative of the population. Now, depending on the number of sampling units, it doesn't have much effect on the sample size. So whatever be the sampling units, the number of the sample size will not be different, but except for your monetary value transactions. Say in case of monetary value transactions, higher the value of the particular transaction to which I have to increase the more of the samples, select more samples. So except for that, other cases, the sample size has a negligible effect with respect to your sampling units, number of sampling units. Now, what is the effect of material misstatement with respect to the sample size? So, greater is the level of material misstatement as expected by the auditor. Auditor, he applies the test of controls, substantive procedures. He also compares the current quarter or current year data with the previous year data. He performs various other procedures and he comes to a conclusion or he expects that the material misstatement amount will be greater. In such cases, the auditor has to go for a bigger sample size. So these are the factors which actually influence the sample size. So one is higher the auditor's assessment of risk of material misstatement, higher will be the sample size. More is the use of substantive procedures, other substantive procedures. For the same particular assertion, the sample size will be reduced. Higher the tolerable level of misstatement, lower will be the sample size. And higher the level of assurance, again, higher will be the sample size. More assurance, more is the sample that has to be checked. Better stratification. That means equal groups covering n number of transactions of varied nature. Lower will be the sample size you need to select. Then about the amount of material misstatement that is expected by the auditor. If it is greater, greater will be the sample size that has to be selected. And finally, with respect to your sampling units. Now, after we have seen few factors that influence the sample size, now we'll see the different terms associated with risk. So first term is with respect to non-sampling risk. So non-sampling risk, as we already saw sampling risk. What is a sampling risk? Risk of selecting a wrong sample. So any risk which the auditor, or any risk that is coming, or any risk that comes and gives rise to a wrong conclusion or erroneous conclusion, and it is not related to sample size or sampling risk, such kind of risk is called as a non-sampling risk. It has nothing to do with the sample size or sample selection. Such kind of risk is called as a non-sampling risk. Now, what is tolerable misstatements? What is tolerable misstatement? Tolerable misstatement is, say for example, some kind of a monetary value is set by the auditor, and he wishes to obtain some kind of assurance with respect to that amount. But actual misstatements, when the procedures are applied in the entire population, the actual misstatements is more than what is actually expected. Say the monetary amount set is, say 1 lakh, but actually when the total audit procedures are applied on the entire set of population, the total misstatements comes to 1,50,000. But up to 1 lakh, the error is acceptable or it is tolerable. So this value is much different, or it is exceeded by the actual misstatement. This is called as your tolerable misstatement. So any monetary amount set by the auditor for which he needs to obtain some kind of an appropriate level of assurance, that is not exceeded by the actual misstatements in the population. That means it is not exceeded such kind. If it is 50,000, if the actual misstatement in the population is also 50,000, then I can say it is a tolerable misstatement. It comes within the purview, or it is acceptable in nature. Now, tolerable rate of deviation. It is a similar concept. Means what is the rate of deviation as from the particular prescribed controls? From the prescribed controls, what is the deviation as set by the auditor than it is actually is. So actual rate of deviation in the population, how far it is different. Say up to 20% it is tolerable, but more than 20, say it is 25, means it is not tolerable rate of deviation. Population, the actual rate of deviation within the population should be same as that of the rate of deviation as set by the auditor from the prescribed procedures, internal control procedures. Now, after these two terms are described, there is another few types of errors associated with sampling. Few types of errors that are associated with sampling. So one of the error is basically there are different types of errors that is associated with sampling is tolerable error and expected error. So two types of errors. One is tolerable and one is expected errors. So what is tolerable error? What is expected error? Tolerable error I can further divide into two. One is tolerable misstatement and tolerable deviation. Expected error. Expected error is nothing. It's something like inherent risk. Some error which is I cannot avoid. Whichever sample size I select, whichever method I use to select the sample, even the sample size is bigger or smaller, no matter what, this error will be there. So this error is some error which I cannot remove or which I cannot eliminate, or it is unavoidable in nature. So how much ever care the auditor takes to select the sample or to determine the sample size, it is prone to this kind of an error. It is called as an expected error. So one is an expected error, it is inherent. Now what is tolerable error? Tolerable error is what? Tolerable error is some error which is acceptable in nature, that I can accept, which is acceptable in a particular sample. Say in a particular sample, misstatements up to 50,000 I can tolerate or I can accept. It is a tolerable error. What are the two different types of tolerable error? Tolerable misstatement and tolerable deviation. What is tolerable misstatement? Say for example, the maximum monetary amount which I am setting, which is, and that particular maximum amount is acceptable in nature. Say for example, up to 50,000, the example I told you, up to 50,000 monetary value, any kind of misstatements up to 50,000, it is under tolerable. It is tolerable. Similarly, maximum rate of deviation, this is with respect to monetary value. Similarly, I am saying as a percentage, tolerable deviation, I am telling 45,000 plus or minus 5% or plus or minus 1%. This is my tolerable deviation. In that is again similar to your tolerable misstatement, but it is a maximum rate of deviation that is acceptable. So basically there are two types of errors: tolerable error and expected error. Tolerable error, it is a tolerable misstatement and tolerable deviation. Expected error, whatever precautions that is being taken by the auditor, it is prone to happen. Samples are prone to such kind of errors. These are unavoidable in nature. Tolerable error is an error that is acceptable in a sample. Two kinds. One is a tolerable misstatement and one is a tolerable deviation. Tolerable misstatement, maximum monetary amount which can be misstated. Say for example, in the example I told as 50,000. Tolerable deviation is a maximum rate of deviation which is permitted. So now we have almost come to the conclusion of this topic of sampling. Now after selection of the sample, after selecting the sampling size, selection of the sample using any of the techniques, deciding on the size of the sample, the auditor will apply the audit procedures. So the audit procedures will be applied on this particular population or this particular sample selected from the population such that the particular sample is representative of the population and the population is appropriate for the particular audit objective. So taking into consideration all these, the auditor applies the procedures to obtain sufficient and appropriate audit evidence. Now, once the audit procedures are applied, the auditor has to evaluate. He has to project the misstatements and evaluate. Now, he is not applying the audit procedures on the entire transactions, only on a small sample that he has selected. Now, what he has to do? He has to project whatever is the result obtained on that particular sample to the entire population or to the entire number of whole set of transactions. So this is called as projecting the misstatements. Now the auditor has to project the misstatements for the entire population to obtain a broader view regarding the characteristics of misstatements for the population. Now, one scenario could arise. If the misstatement is an anomaly, that means only it is restricted to that particular sample. It is not representative of the population. That mistake is only happening for that particular sample selected. In such cases, the auditor does not project that particular misstatement to the entire population. Or while projecting the misstatements to the population, this particular anomaly is excluded. Because that is only a one-time thing, or it is it happens for a single instance. In such cases, auditor doesn't project the misstatements to the entire population. Now, once after the auditor projects, he shall evaluate the result on the sample. He shall evaluate the results. Whether the particular result, that means whether the particular result, whatever he has obtained, whether it has provided a reasonable conclusion about the population. That means any kind of error or any kind of misstatement that is shown by the sample is same when it is projected to the population, when it is showing is it showing a similar effect on the entire population. That the auditor will check. If there is no kind of if the auditor is not able to come to a reasonable conclusion about the result of the sample and that of the population being tested, in such cases, he shall intimate the management about what is its specific error or what is the specific misstatement, is there any chance for potential misstatements or what it has to be corrected or it's a one-time thing. It will be discussed with the management. So this is about evaluation of the results. So we have seen what is sampling, different terms associated with sampling, what are the different approaches to sampling, statistical and non-statistical, different techniques of sample selection. Different techniques included your random sampling, systematic sampling, monetary unit and haphazard sampling. Under random sampling also we saw two methods. One was your simple random selection and one was a stratified selection. In your systematic sampling also we saw two methods, block and the cluster sampling. Finally, we came to what is sampling risk, a risk associated with selecting the wrong sample and how is it related to the sample size. So higher the sample size we saw, lesser will be the sampling risk. Then we saw what are the different types of sampling risk, or what are the different erroneous conclusions that sampling risk could give rise to. One was with respect to material misstatement and one was with respect to controls, test of controls. Then we saw what is a sample size, what are the factors involved in selection of a sample, and what are the different other terms associated with sampling risk, that is your non-sampling risk. Then we saw what is a tolerable rate of deviation, tolerable misstatement, and we saw two types of errors. One is tolerable error and one is a expected error. And the tolerable error also we saw two bifurcations or two divisions for the same. One is tolerable rate of deviation and one is a tolerable misstatement. So both, again we saw what is after all the sample selection, the auditor will be applying the audit procedures, and this audit procedures, after applying the audit procedure, whatever result he gets, he projects the misstatement to the entire population. Whatever result is obtained from the sample, it will be projected to the entire population, and then he shall evaluate the result, whether the result of the particular sample and the population are the same. If not, it will be communicated to the management. So now we have come to a conclusion of this particular session. We will see in the next session with a different topic. So I hope it was understandable and all the concepts were covered for this particular essay 530, that is audit sampling. Thank you.